Okay, hi everyone. Gonna be the second video here for chapter 13. Last time, right, we looked at defined benefit plans, the pension, and then defined contribution plans with an emphasis on 401k accounts, right, traditional and Roth. This video, right, we're going to look at our non-qualified plans, namely non-qualified deferred contribution or compensation plans on there, and then IRAs, individually management retirement accounts, and then finally round off the lecture with some self-employed retirement accounts and look at a saver's credit. Okay, so with that, right, let's see where we were here. The next thing we're going to talk about are non-qualified deferred compensation plans, right? These are non-qualified plans. And the most typical one you're going to see are these NQDCs, right? Non-qualified deferred compensation. Typically who we offer these to, right, are going to be like highly compensated individuals like our CEO. In other words, we are allowed to discriminate, pick and choose who we offer these to. And typically under this NQDC, right, employees like Toad, for example, get to defer current salary in exchange for a future payment from the employer. Tax consequences similar to qualified plans insofar that contributions to these accounts reduce the employee taxable income in the year of contribution. And then on the back end, when it's pushed out to them, it's going to be ordinary income on there, right? So we have kind of our CEO here. Hey, we're going to defer a portion of our current salary. We're going to control how it's invested theoretically. And then later on, our employer is going to pay us that. And at the time, we'll include it in our income on there. So as we mentioned, right, employers are allowed to discriminate in these plans. Typically, they'll use them as a hiring strategy, right? Like imagine you're trying to hire a CEO on there. That's a very kind of select few people that you would want. You have to give them, right, a big salary. You have to give them stock options, right? All of these other things come into play. A non-qualified deferred compensation plan could come in there to attract them. Right now, we said essentially it's a deferral mechanism, right? Where we say, hey, the employer says we will pay you later. And Toad, for example, would hypothetically control how the amount would be invested over that time. Here's the deal, though, right? The employer doesn't actually have to fund it, right? However, employers are ultimately responsible to pay it under the employee investing strategy. Big thing here is as if the funds were actually invested like Toad said, right? So, hey, Toad says, defer $100,000 of my salary. Please put it in Apple stock. Pay it to me in 10 years from now. Does not mean that the company actually has to take that money and go buy Apple stock. However, if and when they go to pay Toad, right, they have to pay him the amount as if they did do that, right, and kind of figure that out. Now it says the employers, right, they can only deduct the actual payments, i.e., like you have to wait until they pay it, you don't accrue it on there. So let's look at a simple example here with 1313. We have an employer that has a non-qualified deferred compensation plan. They defer 10% of their salary. Looks like there's a $50,000 payment, right? So it's like, here we are, please defer. Ultimately, they pay out $50,000 later on. At that point in time, right, the employee who gets it is going to have to pay tax on it. Right, obviously the employee gets to make the investment choices. You have to look at their marginal tax rate at the time of contribution and distribution to figure out like, okay, what makes the most sense here. Obviously, if Toad, for example, thinks he's going to be, in a low tax bracket later on, this type of plan may be very, attractive to him, right? Pay me later when I'm in like the 10% income bracket, not now when I'm the highly qualified CEO making, hundreds of thousands of dollars on there. And again, we said, employers are not actually required to set this money aside. So Toad, one of the things you are kind of running the risk or assuming the risk of is that this employer is going to be there in 10 or 15 years to pay you. If they go bankrupt, sorry, you're out of luck on there. All right, so far we've generally talked about employer-provided plans, right? You work for an employer. However, not all employers provide these. It doesn't mean, right, just because these exist, a 401k or a pension, it doesn't mean that your employer has to offer it. Likewise, just because your employer offers a 401k, it doesn't mean they have to provide a match, right? These are part of the things you do when you compare job offers is, there is some flexibility here between employers. In the event, right, that your employer does not offer, a retirement account, or if they do, right, and you want to add on top of that, you can create an individually managed retirement plan, right? So these can be used independently from, right, like i.e. your employer does not offer, or in addition to your employer does offer a 401k on there, but you want to have an IRA on top of it as well, you can do that. Same thing if you're self-employed, right? So if you have W-2, right, you can get a 401k and you can open an IRA. If you're 1099, right, and you're self-employed, we will see the retirement accounts there, right? You can have a self-employed retirement account and an IRA. So this is in addition to. In the event you didn't have either of these, right, you could just open an IRA if you wanted on there. Now, when we talk about an IRA, an individual retirement account, there's really two flavors, right? The traditional versus the Roth. You could contribute to both theoretically up to the limit for the year on there. Similar framework here when we talked about the 401k, right? With the traditional, right, it's kind of the smiley upfront, potentially a deduction here for the contributions, and then frowny on the back end when you pull money out of a traditional IRA, it's going to be taxable on there. With the Roth, right, it's kind of the frowny up front because you got to pay tax on the money, and then after your after-tax money, you contribute, but it's kind of smiley on the back end. Theoretically, when you pull the money out of a Roth, assuming you meet all the criteria, the account's been open long enough, you're the right age, you won't have to pay tax on that amount, right? So we have kind of a simple example here. Hey, our employer doesn't offer a retirement plan, we're going to have an IRA. Or they do offer one, we're going to have an IRA on there. Let's talk about the traditional IRA, right? So we'll talk about Luigi there, right? It's like traditional, you think of Mario and Luigi. And then Roth is the reverse. You think of like Wario and Waluigi. In any event, right, each year, right, the maximum you can put in your IRAs between your traditional and your Roth, so when you're looking at both of them, the most you can put in is the lesser of $6,500 of your earned income on there. A lot of the times, right, people are like, they just think 6,500 or whatever the amount is. It's the lesser of your earned income. So if you're a student, for example, right, and you make $3,000 this year from your internship, you can't put 6,500 in. The max you can put in is your earned income there. That's the lesser of the two. But most of the time, this gets associated with this like flat dollar amount, 6,500. Now, we said you get the smiley up front, right? Like theoretically, insofar that with the traditional IRA, you may be eligible to get an above the line deduction for that contribution, right? Roth IRAs are the reverse. It's kind of, like frowny up front and then smiley on the back end. Okay. So when we're talking about the traditional IRA, right, we got Luigi there. There's a difference between being able to contribute to it and whether that contribution will generate an above the line deduction. In other words, you always can make a contribution to a traditional IRA, but that does not necessarily mean you will receive a deduction for that contribution, Most of the time you will, but you could be phased out. So by way of example here, right, putting 6,500 into the account plus getting the above the line deduction, right, that's like the end of the rainbow if everything is perfect. We will see there are constraints that basically cap or limit how much of an above the line deduction you could get, right? So we know that $6,500 is the total amount that we can put into our IRAs. Let's say that we just put all $6,500 into a traditional IRA. However, right, let's say that Luigi, one of the constraints is his income, right, is too big, right? So by virtue of his income, there's going to be a $2,000 phase out on there, on the amount that he gets the deduction, right? So you can always put the 6,500 in. How much of the above the line deduction you get is based on your Maggie, right? So here in this example, right, he puts 6,500 into the traditional, but of that amount, he's going to get the above the line deduction, and 2.5 no deduction on there, right? That's the setup with it. How do we know, right, how much we're going to get the deduction for or not? That's kind of the relevant thing here. Well, one of the things is, right, and if, like, for the exam, they're just going to be single, the taxpayers. Be aware there are more complicated things if you're married. But if you're unmarried, you're single, and you're not participating in an employer plan, in other words, there is no 401k or anything like that, essentially the amount you can put in is 6,500 or your earned income, the lesser of those two. In other words, no 401k, and the only thing you have is your IRA, you can't be phased out because of too much money on there. However, right, if you are participating in an employer plan, you're at your CPA firm, right, you have a 401k on there. Hey, I want to put into a traditional as well. Will I get the above the line deduction for it? Well, we have to look at your Maggie on there, right? If you're roughly below 73,000, which maybe at the start of your job you will be, hey, that's great. You can put in the entire 6,500 and get a deduction for the entire 6,500, above the line deduction. If you're 73 to 83,000, and don't memorize these for the exam, but just be aware, high level, you're partially phased out. Once you get above 83,000, right, you can basically kiss the traditional IRA, at least getting the deduction for it, goodbye. And at that point, the traditional IRA, it's like there's no different than putting it in a regular brokerage account. It's actually kind of worse to put it in the traditional account without the above the line deduction, because then like you're stuck with it in there at least until you reach the right age. If you put it in a traditional brokerage account, you can pull it out early with no 10% penalty. But the bottom line here is it doesn't take too long. You know, a couple years into your career, you won't be able to contribute to a traditional IRA on there. You're going to make too much. Now, you can read this, right? Look through it. That's fine. Married taxpayers, different rule set on there. You know, again, they have, are they participating or not participating in a plan? I'm more concerned that you just know the basics with somebody who's single on there. Now, we said, right, 6,500 is the max you can put in. We said, right, you put 6,500 in, and we gave the example where the income, we were kind of in this guy right here where we're partially phased out. We said 4 of that was you got the above the line deduction, and you know, 2.5 of that, nothing, right? So say that we put that in there, right? We put 6,500 in, and we got the deduction for 4 of it. Say a year later, 2 years later, right? That account has now grown to $7,000, right? In other words, of the $4,000 deductible amount, we have earned $300 on that. And on the $2,500 non-deductible amount, we have earned $200, right? It's like 500 plus 6.5. That's how we have the 7,000. What happens here, right? If we were to pull the money out, on there. So deductible contributions, right? These guys up here and growth, the 300 bucks, are taxable whenever we pull it out on there. Non-deductible contributions, right, i.e. this right here, are not taxable. In other words, we basically used after-tax money to fund that on there. However, right, as we have here, growth on it are taxable. So, just be aware of that on there. If you take a partial distribution from a traditional IRA, you have to kind of break this out using a formula on there. So when can you make these contributions, right? Like, here's kind of the deal, right? You know that like 83 grand is roughly the phase out, right, on there. Say you're working during the year and you're like, in your second or third year, you don't know what your bonus is going to be. Maybe you can contribute, maybe you can't contribute on there. What they let you do is, like if we're talking about year one, you can wait all the way until 4/15 of year two to make the year one contribution. In other words, hey, you get the W-2 here, you know what your bonus is. At some point during, when you get your tax documents, you'll be able to figure out, am I phased out, am I not phased out? You have until that point in time to contribute it. Alternatively, if you know exactly what your income is going to be, then you might as well put it in and make the contribution as early as possible, take advantage of those tax attributes and the time value of money. But not uncommon, right, for people in error to contribute, right? They put it in thinking that they're going to be good. Oh, we made too much money. We shouldn't have done that. That becomes a headache when you put money into an IRA, when you contribute, when you shouldn't have on there. Continuing here, right, let's talk a little bit, about these, right? So the distributions, we said distributions other than non-deductible contributions, i.e. everything, all this blue stuff, not the red stuff, all the blue stuff is ordinary income on there when you pull it out, right? So on the one hand, when you pull it out, you're going to have to pay tax on whatever you pull out other than the non-deductible contributions. In addition to that, right, if you pull it out before 59.5, you're going to get hit with a 10% penalty on there. There are some exceptions, right? So the general rule is tax plus 10% penalty. The exception, at least to the penalty, right? You're always going to have to pay tax, like income tax on it. You could potentially get out of the penalty on there for things like medical expenses, health insurance. Hey, you're paying for college. You have a kid. Here's a big one that's very common your first couple years. I need to buy a house, right? I'm saving for my first house. I have a lot of money in my IRA. Take it out up to 10 grand on there. The other thing to be aware of is because it is traditional, right, we do have RMDs in play. In other words, once you hit 73, they force you to start taking out of it. If you don't, you're going to get hit with a penalty, right? So again, you don't want to take it out too early from a traditional. You don't want to take it out too late on there. Let's talk about the Roth IRA, right? So we have Waluigi. This is kind of the reverse in the sense that we have Frowny up front, but Smiley on the back end. So the contributions are not tax deductible. However, qualifying distributions are tax-free, i.e. Smiley. Again, across the board, $6,500 or our earned income, whatever is smaller, we can put into our IRAs between traditional and Roth. But when we're talking about the Roth, right, you also can be phased out for whether you contribute, right? It's a higher phase out, right? So this might be like, if you're in public accounting, years 1 and year 2, hypothetically, you could contribute to a traditional. Then you're like, uh-oh, I make more than 83 grand. Years 3 through maybe like year 7, then you would probably put into a Roth, because you can see the phase outs here. You're not phased out fully from contributing until you hit roughly 150,000, right? So we will say it's subject to a phase out. We will learn about something like, even if you're phased out, you can use a back door, kind of like a secret way to contribute. We'll talk about that. Now we said, right, qualified distributions from a Roth are not taxable. So what does that mean, qualified? Two things here, and you need to know both elements. One, the account has been open 5 years, right? So 5 years open, plus generally, right, 59.5. If you meet those two things, or you die, or first time home buyer, right, you get the smiley on the back end. If you fail either of these, one or both, then it's considered a non-qualified distribution. And with non-qualified distributions, it's not necessarily taxable. In other words, we have to look at the composition of what it is we pull out from the Roth IRA. In other words, to the extent you pull out contributions, right, no tax, no penalty. However, to the extent you pull out earnings on it, right, the growth, then tax plus maybe penalty, right? We will see this maybe penalty. It depends, right, your age on there. We will look at an example with that. So let's look at this kind of from, framework, then we'll look at 1317 here. All right, we said non-qualified distributions. I put the money in, I put the money in, I put the money in, I pull it out either before the account has been open 5 years or I hit 59.5. What are the tax consequences? First, right, when you pull that money out, we're going to say the first thing that we're going to pretend the ordering rule here is that money comes from the contributions, the after-tax contributions you put in there. So you're not going to have to pay tax on that. You're not going to have to pay penalty on that. Afterwards, once we eat up all those contributions, then we're going to pretend that the rest of the distribution came from the earnings on here. In this case, right, we are going to have to pay tax and maybe pay the penalty depending on the facts and circumstances. For this reason, right, you can view a Roth kind of like an emergency savings account. Let's look at an example here, give us some numbers, right? Imagine you have a Roth, right, and you put $5,000 in, right? So here you put 5 grand in. It earns, right, so it's contribution, it earns $500. At age 40, uh-oh, that's not good, right? It's before 59.5. You pull out, right, so you have 5,500 in there in your account, and you're like, look, I'm going to withdraw $5,100. Is this taxable, this $5,100? Well, of that amount, right, the first 5,000, right, we're going to draw from this pile your contributions and say, look, no tax, no penalty on there, right? So we have 5,100 that you pull out, the contributions, no tax, no penalty. In addition to that, right, well, you pulled out 5,100, the remaining 100, that's going to come from this growth up there, right? And in this way, right, we're going to have to pay tax plus, given these facts set, right, because we're less than the age, right, the idea here, we're 40, i.e. not over 59.5, right, we're going to have to pay 10% penalty on that. So $10 on there from it. And one of the things with Roth, right, we saw this with the Roth 401k, no RMDs. Let's look at 1317 here. We have a taxpayer, they contributed $4,000 to a Roth. They retire at 65, and the account is worth $60,000. They pull out $10,000. Assume they have a tax rate of 30%. Well, the idea here is we're over 59.5, plus the account has been open 5 years. Check, check. It's a qualified distribution. No taxes, no penalty. Let's change the facts, right? Now the taxpayer is 57 on there, right? So we over 59.5 in 5 years. Uh-oh, right? We fail that one. So it is a non-qualified distribution on there. In this way, right, we're going to say, hey, you put into the account $4,000, right? That was your contribution. We're going to say $4,000, no tax, no penalty, but of the remaining $6,000 you withdrew, right, because you pulled out 10 on there, right? 4 of the 10, no tax, no penalty. The remaining 6, tax, right, 6,000 times 30% plus penalty on there, right? You get the penalty when you fail this side, when you fail age equals penalty on there. Let's compare that with down here, right, where there's 62, and let's assume that they fail the 5-year rule, right? So greater than 59.5 plus 5 years, right? In this case, check, we pass that, we fail that. When we fail, and we pull the money out of here, right, the contribution, no tax, no penalty. The earnings in this case, right, the remainder of it, because in this case we pulled out 5,000, right, we will have tax, but no penalty, right? So if you fail 5 years, no penalty on there. Slight difference, but be aware of it, right? That's why it says back here, right, potentially subject to, 10%, depending on age plus if account is open 5 years. Now, one of the things, right, is that, relatively speaking, Roth IRAs are like a new thing. So all the time before that, right, people had traditional IRAs, but whenever they created the Roth, they were like, look, like, had this Roth been here, I would have contributed to that. So, Congress, the government, the IRS responded, they said, look, we will let you, basically, if you take money from a traditional IRA and put it into a Roth, right? That is called a rollover, right? You basically have your traditional in there, you push the money out, right? You pay tax on it, right? Whatever the leftover is, i.e. the after tax, you put into a Roth, right? That's called a rollover. We talked a little bit before, right? And there is like certain time you have to do that in, right? So look at those, right? Like a 60-day period. But one of the things we said before, right, with the Roth is you can be phased out. Hey, I make 200 grand, I can't contribute to a Roth. Here's the workaround for that, right? A backdoor Roth. Essentially what you do is you put the money into the traditional, right? Obviously, like you're not going to get the above the line deduction for that, but you can still put the money in, push it out, pay the tax, the leftovers, then put it into the Roth on there, right? So you can see that, idea here in this example when you look at it, where they withdraw it and then they roll it over into a Roth on there. Sorry, I'm going into the, the lecture there on that. Next, right, be aware of some self-employed plans, right? So if, hey, you don't have a W-2 job, you're self-employed, we have a SEP IRA and an individual 401k. You can also, on top of this, have an IRA if you want, just like a traditional or a Roth on there. So again, the idea with these is, hey, I'm self-employed. I can open a SEP IRA where essentially the amount I can put in there is the lesser of $66,000 or 20% of my Schedule C net income. You can look at 1319 on there. Some complex math, less concerned, right? Don't be worried about some giant math equation for the self-employed taxpayers. Just be aware of the basic attributes of these accounts, right? So with a SEP IRA, there's other factors you have to be aware of, right? If you have employees, then you must contribute to their SEP IRA. So the person who this would be best suited for, right, is probably somebody who does not have employees. Another option are individual 401k plans, right? Again, the lesser of you can put in this during the year is 66,000 or 22.5 plus 20% of your Schedule C net income on there. This plan, individual 401ks do allow for catch-up contributions, not always the case for these other self-employment plans. Not available if you have employees. They are an administrative burden, and they could be set up in a traditional capacity or a Roth capacity. Finally, here I want to talk about the Savers credit, right? This is a non-refundable credit that, hey, we're trying to encourage middle and low-income taxpayers to save for retirement, right? And essentially what we will give you is a credit for any contributions you make to retirement accounts, when we look at the contributions up to $2,000, right? So if you put $2,500 in, right, the max you would get is $2,000 in the calculation on there. And again, you get this in addition to any deduction allowed for the contribution, like above the line, stuff like that. So they do kind of give the double dip here. Who qualifies, right? You at least have to be 18 and you cannot be a dependent of another or a full-time student. So many of you won't be able to qualify because you're a full-time student. How do we calculate this? Right, it's going to be the contribution we put to the account, right? The max is 2,000 times the applicable percentage from the IRS table. Ultimately, right, in this way, the percentage is going to be 50% at most, meaning like the maximum credit possible is $1,000. Let's look at 1323, right? We have a taxpayer, right? They earn $27,000. They put $4,000 into an IRA. That's great. They get an above the line deduction for that. Let's just say their AGI then is $23,000. we want to know how much is their savers credit, right? So they put $4,000 in. However, we know it's capped at 2,000. So that's kind of step one, is figure out the number, with the $2,000 cap. Step two is, right, we got to go to the table, right? So we go down here to the table, all other filers. So we're going to assume they're single here, right? We are looking at an AGI of, let's see, what are they saying here? 23,000. Right, so we're going to be in this guy right here, 20% for step two. Use the table, multiply. Hey, there is our savers credit. So be aware of the cap, 2,000 maximum, step one. Step two, go to the table based on the AGI on there. So that's it. I'm going to end the lecture here. Good luck.